All right, we've got a sell-off that is accelerating on both sides of the border. No shortage of anxiety on the debt ceiling. It faces a key vote in the House of Representatives today. We got signs of further weakness in China. That is certainly putting a lid on performance on the TSX, which has already struggled. It is down at a 2-month low. Energy has been the biggest pain point, but our next guest has been adding to energy exposure. We've got Rob Lauzon, who's the Chief Investment Officer at Middlefield Capital. Thanks so much for being with us.
Nice to be back.
So it's got kind of this classic first is worst situation where last year energy was great, this year it's not. But I mean, we've had production cuts, we've had the great Chinese reopening that's not looking so great. What's happened to the energy thesis since last year?
Yeah, one major driver, I think, is because of what happened last year, and the generalists went overweight energy for the first time in a decade's probably stretching it, but 2015 for sure, 2016. So, and any money manager that entered the industry in the last 10 or 15 years has been trained to hate commodities. And this is generally the textbooks lately have been tech, growth. You don't need commodities. And in some instances, commodities are dead. Well, if you get on a plane and travel anywhere in the world and you see construction sites all over the world, and if you see where clean technology is going, you know you need copper, you need oil, you need natural gas. So what happened this year was generalists had the chance to finally go back to underweighting commodities and energy because tech started to work. And as you've noted many times today and on previous shows, that's the only sector that's working. Yeah. And in fact, it's about 10 stocks. The rest of the market is in a recession. Every sector, even healthcare now, is starting to deteriorate. So the market is telling you that the world is slowing, and commodities, energy in particular, we'll talk about today, is really getting hit because of that. And there's been just outflows. One other point is, if you just go back when oil was $100, even higher, but $100 during the first part of the war last year, and there was a shortage of natural gas, and Germany was buying up all the LNG they could find to make sure they had enough for the winter. When you go year over year comps, oil from 100 down to 70, and natural gas world prices 30 down to 10, your earnings growth is negative. Yeah. So that's another reason for most investors to get out of a sector. And technology did so much cost cutting in Q4 and Q1. They are resilient businesses. They are like the new consumer staples. We're always on our phones, on Facebook. We're using payments. So we know they're the new consumer staples. So they should trade at a 20 or 22 times multiple, like Meta does and Google. But I think that run is over. I think tech RSIs on tech are 70% or relative strength is telling you to sell. And if you look at commodities, including fertilizers or energy, they're in the 30s, which is the buy signal. So it's tough to do, to buy low and sell high, but that's what you have to do in the market. So it's time to sell a bit of tech.
This is a big call to trim back on tech because and buy energy or commodities, because, you know, I made the point earlier, maybe we shouldn't get too cerebral about it. Tech is working because the fundamentals for tech are working. Everything else is not working because the fundamentals are not working for those sectors. So what gives you the confidence to get contrarian? What are you looking at that says, no, I feel like we're going to get a mean reversion again?
Well, one is rates have stopped going up at that rapid pace. Maybe we get a couple more in certain countries around the world, but we're in the 8th or 9th inning of rate increases. So let's look forward 6 months. That's behind us. In addition, one reason China's been so slow is really the manufacturing of goods has been ground to a halt. So the Canadian Tires of the world, Best Buys, have been destocking. And because of the uncertainty in the macro, they haven't had any urge to use working capital to restock everything full.
Okay.
They're taking a bit of a chance that we don't have another pandemic or supply chain issues, but supply chain costs are coming down, shipping costs are coming down. So it could be perfect timing for these retailers to start ordering now for second half. And that's when industrial production will pick up in China, when those orders come in.
So you're not fussed by the slowdown?
Not right now, because the increase is going to come in the second half in early 24, which will get commodity prices going again.
Unless the recession happens.
And we're in the soft landing camp.
Okay.
If I was in the hard landing camp, I wouldn't be here telling you to buy commodities. Commodities are pricing in more than a soft landing. They're almost in that hard landing camp right now. So you're getting an opportunity if you're of the view that we're going to maybe have a mild recession, nothing major. Listen, the central banks have the ability to cut rates now, where they didn't have that ability 2 years ago when rates were zero. So I think things are lining up that a well-balanced portfolio in the second half will do better because you'll get more market breadth. You won't be just tech stocks. It'll be healthcare, energy. Tech will work, but it's not going to be the only thing that works, right? The only way you would have made money in the markets this year is Nvidia and Microsoft. If you own good quality REITs, healthcare companies, energy companies, you're still down. It feels like you're still in a bear market from 22.
So let's talk about some of the names that you've been picking up because it doesn't seem like you're just going into one part of the energy market. You've got producers, Tourmaline, but then you've also got pipelines in Enbridge. What kind of screen? So here are all the names that you gave us: Tourmaline, Topaz, Enbridge, Headwater. Is there a common thread in all of these?
Manageable debt. Tourmaline has basically next to nothing. Headwater has next to nothing on a net basis. Enbridge is in their debt. They're between 4 and 5 times debt ratios, and that's where they are. They all grow their dividends. They all continue to guide the market that they're going to grow their dividends, and they've all pulled back from their highs. I like Tourmaline because it's got the lowest cost gas in North America. It's the largest gas producer in Canada, and I'm a believer that LNG is going to be the next secular growth of energy infrastructure in North America, and Tourmaline will be at the forefront of that. So that's below $60 is an attractive entry point. Enbridge, anytime it's below 50 has been a really good buying opportunity for us at Middlefield. It's there now. It gives you a 7% dividend yield, which grows at about 3% a year, 4% a year. And then Headwater, small cap oil, no debt, looks like they can continue to grow their dividend, but they're in a new play called the Clearwater, which has very robust margins. And they've got a lot of untapped drilling inventory. So that's kind of a growth and income play. So I got an oil play in Headwater, energy infrastructure utility like in Enbridge, which is down 15% from its highs here recently. And then Tourmaline is your natural gas and LNG play.
I like that $50 for Enbridge. So the last 2 times that it crossed below that, it rallied 20% and then it rallied 13%. And then to your point, you're getting a 7% yield now if you buy now.
Sure. So when rates come down in 24, 25, this won't have a 7 yield. It'll be back to a 5.5 to 6.5 yield. It'll be a $55 stock. So you can lock in 7 now with 10% upside. Who doesn't like 17% rates of return?
Enbridge aside, but I know that dividends are now a very attractive part of the energy sector. At what point do you get worried about dividend sustainability? What level of commodity price?
$55 oil, U.S.
We're a long way from that.
And as long as in that environment, the Canadian dollar would have a hard time going back to par. So in a $55 U.S. environment for oil, you're probably Canadian dollar still in the 70s. Differentials have narrowed because of pipeline access increasing. So that's the level that I would become worried, and we're still far from that.
Rob, thanks so much. Fascinating
Good to be back,
conversation and perspective. This is Rob Lauzon joining us from Middlefield Capital.